Good morning, good afternoon, good evening, ladies and gentlemen. Welcome once again to our episode on the investing for beginners. So this is just a continuation. We're going to look on the first title on the why you have to invest. So it's all really trying to understand why you have to invest, trying to answer the why question here. So understand why you want to invest in the first place. So first of all, we're going to identify financial goals. Second, we're going to look at the access to financial situations. So going deep into details really, because the first one is just like giving the quick details. Now we're going really in depth to try to understand why you need to invest in the first place. So the third point, we look at determine your risk tolerance. How much can you cope with? How much can you take in? Or how much can you tolerate? The fourth point would be to set realistic expectations. Since this is a game of expectations, you have to be more realistic and the time which you want to achieve it. And the expectations also, the goal has to be achievable at the same time. The fifth point would be on the motivation and discipline. So it needs self-motivation, self-discipline as well. Then after that, I'm going to give a quick summary, just as I usually do in all the episodes, just to understand really what we learned in this video. So are you ready, ladies and gentlemen? Tighten your belt and let's begin. So this is a continuation on the understanding investment for beginners. I think I'm getting now in depth. If you are advanced, I think this will be useful for you as well. So before diving into the world of investing, it is essential to clarify why you want to invest in the first place. So we're focusing on the why side aspect of investment. So understanding your motivations and goals will help to guide your investment decisions and strategies. So when you understand your motivation and goals, it will help you to guide you. It will guide you through your investment decisions and strategies. What strategies you're going to take, what decisions you have to make. Not to, in case of the common mistakes, which we said in the previous video. So here's how you can approach this step, the why aspect. So number one, we're going to identify your financial goals. So you have to be realistic, your financial goal. You have to set your goals, the milestones. So we're going to look at the short-term goals, like 1 to 3 years. There's a short term in 1 to 2 to 3 years, the goals which you have to achieve in that period, that time span, 1 or 2, 3 years. So this could include savings for a vacation, like a down payment on a house, or an emergency fund. So for short-term goals, you may want to focus on safer, more liquid investments, like saving accounts or bonds. So those are like liquid investments, because liquidity is when you need the money. The money has to be available whenever you need it, and you get it. So it will be like on the saving account or bonds. Those are like, in that case, in the short term, you have to focus on those. So for example, like if you want to buy a car in 2 years, like that is your goal, you want to buy a car in 2 years, so you might save in a higher yield savings account. So if you want to buy a car in that 2 years, you might save in a high yield saving account, or a short-term bond fund to ensure your money is available when you need it. So we look at the medium-term goals. That would be like in between 3 to 10 years. There's a medium-term goals. So this might include savings like for child's education, like starting a business or making a significant purchase. Like you can afford to take a bit more risk with medium-term goals, but you still want to preserve your capital. You still want to save, you preserve your capital. Like for example, if you're planning to buy a home, like let's say in 5 years, you might invest in a balanced mixture of stocks and bonds. So in that case, you mix the stocks, the more risk, bond, the more safer, but the return is slower. In the case of stocks, the more risk, but the return is faster as well, quicker. So aiming for growth while managing risk. There's like the medium-term goals. We're going to look at the long-term goals, let's say 10 years plus. That'll be like in long-term, like retirement, like leaving a legacy, or building a substantial wealth fall into this category. So if you want to build a substantial goal, it falls in the 10 years plus long-term goals. So like let's say like long-term goals allow for higher risk investments like stocks, as you may have, like in the case of stocks, more risk as well. So those are like high risk investments. So as you may have more time to ride out market fluctuations, like market fluctuations, it's all like ups and downs. So if you're taking like a risk, it's like up and down, like riding a roller coaster really. So example, like if you are 30 years old and want to retire like by 60, so you have 30 years to grow your investments. This is example to use in the previous video about the investment for beginners. So if you are 30 years, we're expecting, or we simply thinking that you are 30 years and you want to retire at 60. So that is your goal. You have 30 years time span to grow your investments. Like investing in a diversified portfolio of stocks can help maximize growth over time. So when you stock like in the diversified portfolio, what simply means is spreading in the way of spreading in the way of stocks or buying stocks. It will help you maximize your growth over time. So number 2, we're going to look at the access to financial situation, debt, like debt management, like consider current debts. You have to consider, do you have any debt? Do you own anyone? Banks maybe? So if you have a high interest debt, like credit card debts, it might be wise to pay that off before investing. So if you have any debt, whether it be bank or anyone, try to pay off before you start investing. So investing with outcomes, like outstanding high debts, high interest debts, can be counterproductive really. So if you invest with outstanding high interest debts, it will be counterproductive, which means it will backfire to you as well, because the returns on investments might not outweigh the interest on your debts. So if you have any debt, the good option is to pay off all the debts. Like for example, if you have like let's say 10,000 or 10k euros in credit card debts at 20% interest rate, so the interest rate is too high, 20%, focus on paying that down first. The guaranteed return of eliminating the interest is higher than what you might earn from most investments. So the guaranteed like of the return of like let's say 10,000 at 20 interest rate, 20% interest rate, the return is too high. The return of eliminating the interest is higher than what you might expect or what you might earn from most of investments, because most of investments are lower once you don't know what you're doing really. Number 2, like with your number 2, assess your financial situations. Let's say emergency fund. So before you start investing, ensure you have an emergency fund in place. So emergency fund is like a liquidity really. In the case when you need it, you have a short time without going to the bank, say I want 10k, 5k or 5,000 euros. Let's say you cannot withdraw all of that money at once. Why you need it? You have to show passport, you have to do this. But whenever you put the money, no one asks you any question. But when it is time to withdraw the money, when deposit, no one asks you the question. When it is the time to withdraw, now you have to prove that it is you are the owner, things like that. So in the emergency fund, like before investing, ensure you have an emergency fund in place, like typically 3 to 6 months of living expense in a liquid. Like we said, you need to have 3 to 6 months really of living expenses in a liquid, in an emergency. Like an accessible account, it's just any liquid, it's just any accessible account or cash really. So this fund protects you from having to sell investments during a market downturn to cover unexpected expenses. Like example, like if you have a monthly expenses or expenditures, if your monthly expenditures are let's say 2,000 or 2,000 euros, aim to have like 6,000 to 12,000 in an emergency fund. So 6,000 is like 3 times of 2,000, or you can go like double to that, 12,000 euros in an emergency fund. So this gives you peace of mind as you start investing. So in the case of investing, we say there's too much stress, heart attack, pressure and things like that, pressure going high. So you have to try to find a peace of mind. You need to have an emergency fund which will take you in 3 or 6 months. So number 3, we're going to look at determine your risk tolerance. How much can you bear? How much can you cope? How much can you swallow? How much are you willing to lose? It's all about your risk tolerance really, like risk appetite. So reflect on how much risk you're comfortable taking with your investments. You have to reflect on that before you get your feet inside, both of your feet in the water. Are you okay with seeing your investment fluctuate in value? Fluctuate simply means up and down. It can be up, maybe down, maybe long time keeps going down and down and down. So that's like the fluctuations or fluctuating value. Or do you prefer steady, predictable growth? Some people might go for steady one like bonds instead of stocks, or predictable growth, like is that the one you like? So your risk tolerance will influence your asset allocation. Your risk tolerance is what will influence your asset allocation. So asset is just a bonds really, or stocks, or financial investments really. Like for example, like how much you invest in stocks versus bonds. So you can, like, your risk tolerance will influence like your asset. Maybe you can put more percentage in the bonds, or more percentage in the stocks, or more percentage, or vice versa. It depends. Like for example, if you have a thought of losing money in the short term makes you anxious, or if the thought of losing money in the short term makes you anxious, you might prefer a more conservative portfolio with a high allocation to bonds or dividend paying stocks. So if you're comfortable with market volatility, you might opt for a portfolio with a higher concentration of growth stocks. So stocks, in the case of stocks, there's a high risk and high income or return as well. In the case of bonds, it is more steady, lower risk and the return is low as well. It comes slow. So number 4, we're going to look at the set realistic expectations. Since we're talking about expectations, you cannot meet all expectations. You cannot expect all expectations to come true. Expect expectations. Expectation varies really. Maybe the markets crash and things like that. All of those really can influence, or all of those can change your expectations. So understanding your returns, or understand returns. So recognize that investing is a long-term endeavor. Like while some investment can offer high returns, they also come with high risks. So that we're talking about stocks in that case. High returns, high risks. So there's a high probability, or they are directly proportional in the case of stocks, higher returns and high risks. So it is essential to set realistic expectations of your investment returns based on your goals, time horizon, and risk tolerance. So you set your expectation or your investment returns based like on your goals, time horizon, and the risk tolerance. Like for example, historically, the stock market has returned about 7 to 10% annually. So, but this comes with fluctuations, up and down, up and down, up and down. In the case of marketing, we're talking about up and down. In economics, it goes up and down, up and down, up and down, like the sine wave. So if investing for the long term, you might expect like similar returns, but be prepared for ups and downs along the way. That is the what about stocks, up and down along the way. Number 5, we're going to talk about motivation and discipline. Self-motivation, self-discipline. Don't expect someone else to come and try to discipline you or to motivate you. It is all about yourself, really. To have your feet grounded on the ground. To have your feet grounded. To know yourself. Your risk tolerance, your strengths and weaknesses. So in the case of motivation and discipline, it's all about consistency, really. So your why will help keep you motivated to stick with your investment. So you know why you got yourself into this, or why you want to invest. So your why will help keep you motivated to stick with your investment plan, even when markets are volatile, even when markets are like messing around and all of that, even when they are not steady, there's a volatile. So whether it is securing your investing, you like retirements, whether it is securing your retirement, like your retirement, paying for your child's education, or achieving financial independence, having a clear purpose will guide your investment decisions and help you to stay disciplined. Like for example, if your goal is to retire at 60 with 1 million euros, like knowing your why will help you stay committed to regularly contributing to your investment accounts and avoid panic during market downturns. So let's say you want to retire at 60 with 1 million euro in the account, in the investment account. So your why will help you to stay committed regularly contributing to your investment accounts and avoid panic during the market downturns. So in the case of panic, is like when people start selling when the market drops down, or when it goes up, something like that. So it's like trying to avoid trading or transactions, selling and buying, because when you're doing selling and buying, the tax also go up. You have to pay tax as well. So what can we say in the conclusion? Like understanding why you want to invest, it is crucial, because you cannot just get yourself to impulsive and start investing. You have to understand why you're investing, what is your goals. You have to set your goals. You need to have a motivation. You have to be self-disciplined as well, to have your feet grounded, and to know why you want to invest and when is your limits, really. Setting your time span. So in summary, we can say like understanding why you want to invest is the foundation of a successful investment strategy. So when you understand why, all the why you need to give the because there, because of this, because of that. So when you understand why you want to invest, is the foundation of a successful investment strategy. By identifying your goals, assessing your financial situations, determining your risk tolerance, and setting realistic expectations, because we're talking about expectations. They have to be achievable in a certain time. The expectations, they have to be real, not just imaginative, not just inside your mind, not just aiming high like you, without considering your weaknesses and the strength. So you can build a plan that aligns with your aspirations as well. This clarity will help guide your investment choices and keep you focused on achieving your financial goals. So when you clarify, like when you you become like a surgeon in knife, you try to separate reality and imagination. You put all the imagination aside, you say this goal is realistic. By following this goal, by following this investment plan, I can achieve my financial goals and become financially secure or financially free. So, and that is what we are aiming. So, ladies and gentlemen, just as we began, thank you so much for listening, and don't forget to watch the first episode if you find this, or if you get lost in the second episode. So look for the first video, Investment for Beginners, the 100 years of investment history. So thank you for watching. Don't forget to comment, like, and share the video. Keep sharing, keep commenting your suggestions as well, or the investment. Keep the comments coming. I'm ready for you. I'm ready to answer all your questions or inquiries. Thank you so much. Ciao.